Welcome in, investors. Episode 13 of the OIG Podcast. I'm Kevin Orsinger here with Max Messett. Today's topic is one that intrigues me. It's understanding investment risk versus return. So, Max, why don't you get us started with it?
Yeah, this is a big topic that we come across, um, more on our side, I think, than an investor side. Maybe not something that always is top of mind. I think it's hidden in a way that they talk about it, and maybe express it to us or express it to friends of the fear of risk, right? And that is something that we go down the path a lot. But what is that correlation between, you hear that risk and then you hear reward, and we talk about that. But the reality of with investing and the reality of with life and money in general is risk is a part of a lot of it that we talk about. And especially on the investment conversation, risk is going to be a part of that conversation majority of the time. It is just how much risk are you willing to take for X amount that you're willing to get in return. And that's not a perfect equation. Again, this is another one of those topics that we can't type in the Pythagorean theorem, A squared plus B squared equals C squared, and tell you exactly that, if your money's here with this much risk that you're exactly going to get this return. Nothing's ever guaranteed with investing. And that's also part of the conversation of where that risk comes into play. I do think this is a topic that's not overlooked, but I think it's, like I said, kind of hidden in emotion. It's part of that emotional connection to money that investors kind of hide with their emotion. But at the end of the day, there is a correlation between risk and return. And Kevin, you've seen it. You've been in the industry a lot longer than I have. Is there anything that kind of comes straight to mind with risk and return?
No, I think investors, the sooner you understand that in order to get better investment returns, you need to take a higher
Yeah.
degree of risk. Again, no guarantees that that extra risk is going to consistently, constantly get you those returns, but it will over a period of time. I can remember a potential client meeting. This is probably 20 years ago at this stage, and it stuck with me because it's just kind of it's for people not in the industry. It gives an understanding. Asked the clients what their expected rate of return was, and both husband and wife said, "Well, 10%. We'd like 10%."
Yeah.
Okay. How much investment loss are you willing to take on to achieve 10% return? And both of them, like they practiced it, said in sync, "Oh my gosh, Kevin, we don't want to lose any money."
Yeah.
And so it's that discussion then of, well, fantastic. To get you 10% returns, we're going to have to put our money at a potential short-term loss.
Right.
So the quicker anyone can understand how that works, and again, significantly more risk doesn't necessarily mean significantly more returns.
Right.
You still have to be invested in good stuff. Stocks are riskier than bonds, but within stocks, there are stocks that are riskier than other stocks.
Yeah.
And so you have to kind of balance that out. But I think understanding from an investor standpoint that the better I'd like my money to do across 5, 7, 10-year periods, the more I'm going to have to put that money at risk, that in the short term, I'm going to be down 10, 15, 20%.
Yeah.
And as long as you understand that and you can stomach it and it fits kind of your big picture plan, it all makes sense.
And kind of with that, I guess I'm going to swing back to just kind of what risk even means to an investor. And a lot of that conversation for us is the stock versus bond equation, equities, versus more fixed income stuff. Kind of the way we look at it is the weight on those. How much of your money do you have on that stock side compared to that bond side? But I kind of do want to put out there is still risk across those board. Like you said, some stocks may be more risky as we talk about having your money into. There's also on the bond equation, though. Just because you hear the word bond doesn't mean, I'm 100% safe and it's 100% my money's just going to do this. We're not talking CDs when we talk bonds. And something that's very, very, I think the fixed income kind of puts that wrapper of, I'm 100% safe. Even on that bond side, there is a spectrum of risk that you can take inside of that. Now, we won't go into the weeds and try and put numbers out there, but just I did kind of want to hit that baseline of there is investment risk across the entire board with investments. But kind of like you said, how you weight each of these categories really is what adds the extra risk, and then also that potential for the extra returns. And that's kind of, as investors with that emotional connection to your money, you have to decide, what am I comfortable with? and not jumping into it, but another important part of working with a financial professional allows you to put all that on the table and allows them to also kind of navigate where you feel and insert any advice they might have of, hey, another great topic we'll get into is time is still on your side. Someone that might be on the younger side, you have the time to be a little more risky, as we like to say, or a little more stock equity heavy to allow your money to have those roller coaster rides of jumping up and down. In the long term, though, having an opportunity to probably make some more money on your money compared to, down risking that, as we'll say, to a little less weight in that category, a little less risk, but also a little less return. But with time on your side, you can afford to do so in the long term, as long as you don't need that money in the short term. That's kind of what you talked about, is that short-term loss. When we look at risk, and again, not guaranteed, but the long term is really the horizon we focus on of where is this going to get you in that 5, 10, 15 year span, not the 6-8 months where it's like, hey, we're going to hit a home run here. That's not the idea behind the risk conversation we have. And I just didn't want, let's not forget that time is the most valuable asset we have when investing conversation comes up.
Yeah. And a lot of it as an investor, you have to weigh the returns you'd like to get versus maybe need for what your plan is, versus as the markets go down, are you going to have sleepless nights? Are you going to be in panic mode? When the markets are not doing what you expect them to do. Again, in the short term, in the long term, everyone's going to be just fine. Our job as investment advisors is to help manage that investment risk before $1 is invested in some of the things that we choose. But ultimately, you need to balance getting the returns you need to make your money last and live the retirement that you want, or whatever that money. So maybe you're just putting it aside for 20 years from now to buy a second home, but whatever that goal ends up being. But you have to manage the returns needed or expected versus how do I feel emotionally when things aren't going my way? Because I think we've mentioned in other podcasts that 8 out of every 10 years the markets are positive, which means that 2 out of every 10 years they're not. And you learn a lot about an investor's risk when things aren't going well. Yeah. It's very easy to be a risky investor when the markets are doing well, and it's a little harder to stomach that when they aren't. Smart investors understand it's a long-term play, and that comes with experience sometimes too.
Because I kind of want to, swing back on the cycle that we look at, and sometimes this gets flipped upside down and we do these podcast series to try and correlate everything. And at some point we like to wrap them together, show how this correlates. Somebody that maybe didn't start early enough, somebody didn't put enough money away that they're realizing, they're coming up 50, 55, retirement's starting to tick in their head. They're seeing the wheels spinning. The upside down picture is a lot of times people then go, well, crap, I'm going to need 12 or 15%. Like they start running the numbers, right? And they're like, if I'm going to get anywhere near a spot that I got to retire, I got to up my risk. And these are the times. And you can, but not necessarily the right times to be the most risky in your life. And I know you've seen that time and time again of the, it's that last, hey, we have X amount of years and I need this to get to my goal number. This just shows again the importance of starting early and allowing time to be on your side, being more risky, as we like to say, up front. So you're not in that position where, hey, I got 3 years left and I better get 25% returns a year or else I'm in big trouble, right? That's kind of the upside down. The ideal situation is, hey, we did enough early enough, was risky enough. We can start to down that as we go towards retirement and say, hey, we can't afford to take these big swings because any day I want to walk out of the office and not come back. And I want the opportunity to do so, right? That's a big part of that game too. So any thoughts on that as far as, I know that one way to avoid it is always to start earlier, but what are the thoughts around those last couple of years, maybe rolling into retirement? Yeah,
I think our role in that is to have realistic conversations with clients of, listen, that's great that you want 15% returns. And if that happens in a bubble, everything looks great at retirement at age whatever. But let's talk about the reality of that happening. And let's talk about the worst case scenario that if in that 3-year period where we're trying to get 15% returns, we're super aggressive. If the markets go down 2 years in a row, you went from, I don't quite have enough to retire to, I can't retire now. So again, we would probably advise you against doing that. But at a minimum, we're going to have a conversation of, to make that happen, this is the level of risk. At this level of risk, here's the loss potential.
Yeah.
And again, it's not a guaranteed this worst case scenario, but historically speaking, this type of portfolio, when things really go sideways, you could lose 40%. You comfortable with that? Can you live with that? Oh my God, no. Okay, then we should probably stay away from that portfolio. We're trying to get you double-digit returns.
Yeah.
Consistently. And most people are receptive to that. I think people say that sometimes in hopes that we're going to be like, yep, that's the greatest thing I've ever heard. Let's make that happen for you. And the reality of it is it's not quite that easy.
Yeah.
It's not quite that easy. But, and you've mentioned a couple times on it, time is your best friend. You can absorb a little bit more investment risk because you have a little bit longer time to make up losses if they're a little bit more significant. And as we've mentioned on some of the retirement podcasts, that even in retirement, you have a longer term time horizon. You retire at 65. You're 20 to 25 years, maybe 30 years in retirement. That's still a long-term time horizon.
Yeah.
Doesn't mean you're as aggressive as you are as a 30-year-old.
Right.
But it also doesn't mean at 65 that you take risk off the table completely, because then other items are going to negatively impact you, inflation and things like that, as your money is not growing enough. So it's a catch-22. But from our end, in explaining it to maybe newer investors or investors that haven't had the opportunity to have that conversation, is just, understanding both sides of it. Higher returns, fantastic, but comes with higher losses. You comfortable with that?
Yep.
And if the answer is, yep, I'm perfectly fine and I'll live with whatever consequences happen, okay. And if it's like, oh my gosh, no, that scares the heck out of me. Okay, so maybe we take off the 15% potential returns off the table and go to something that's a little bit better for your mental health, that can maybe not get you to your goals exactly, but get you a heck of a lot closer.
And I think that's just something important that you're saying right there. Maybe not, so you can't have if the answer is, oh my gosh, I can't stomach that at all. It's then you got to kind of change maybe what your goals or the reality of what that looks like, how to get there. I think sometimes we run into, I want 25%. Were you willing to lose 40? Oh my gosh, why would you ever say that? No way. But the number doesn't change on paper, right? It's always, but I want $1 million. Well, the only, there's a direct correlation. You can run the numbers to see what you have to get there with, maybe what your savings plan is or what you're putting money away to invest. And again, it seems to be not the magic wand wave, but it's always, how do I get there? We tell them, hey, I don't know. I don't know if that's for me. And then the number doesn't change. So being fluid, like we talked about, I think is where that kind of goes. To understand your emotional connection to it. What can you stomach? And then adjusting based on that.
Yeah.
So
we've had people before that, they were at a certain risk level and it was fine when things were going well, but you get 18 months or 24 months of the market's down, and they realize themselves that, boy, my goodness, maybe I'm not wired for this, or maybe I was at a certain age and I'm not anymore. And it's okay to make adjustments. We usually scale down investment risk as clients get older, because not that we don't want their money to continue to grow. We still do, but we don't need 75% of it in equities at that stage. So maybe it goes from 75% to 50%, and the other 50% in bonds and cash and things like that are lower upside, but also lower downside risk. Still have the opportunity for some market returns, still get to participate in that, but we've significantly changed the risk profile of that portfolio. And I think that's important. And the word fluid, as you use it, is a perfect one, because day in and day out, things change. So obviously year in and year out, they're going to change, and you need to be willing to make adjustments with that.
That's a great way to say it. Yep. Because like you said, even the 65 conversation, rolling into retirement, I think a lot of times the conception is, well, I'm out of the market, I'm retired, I'm just using my money. And that's not the case either. There's still investment risk that is attached to that, because you got to make sure that you're hedging against what you're going to be taking out of that account. That's the end goal, is how do we still fill that bucket? As I like to say it, is you got a big bucket and you poke a hole in the bottom. It's a continuous stream. How do you take the hose and keep putting water in the top so that bucket doesn't just continually drain? Got to try and find a way to make that money last, because you still have a long time horizon. And then I know kind of the topic that we talked about previously is kind of ways to hedge some of that risk. And we talk about that diversification. A lot of that's on our side when we have those conversations. But just for a quick, maybe investor side, is there anything that comes to mind on the diversification side of investments for? Yeah,
owning not a little bit of everything, but a little bit of a lot of things is good. And that's one of the ways you hedge against risk. Is, if you're investing in different sectors, energy is doing fantastic now. Healthcare isn't. Utilities is doing well now, and some other ones aren't. So, you want a piece of a little bit of everything, or in our case, we try to move in and out of sectors as we can. But yeah, you want to own, you want to own the NVIDIAs and Googles and Apples of the world, but you don't need it to be 60% of your portfolio. We want to participate in the good part of it, and we're also going to participate in the bad part, but it doesn't need to be probably more than in any single position, any more than about 5% of our portfolio. And that on its own, that's when I talked earlier about, like, our role for clients is to manage that investment risk before a dollar gets invested. And part of it is in the investment selection. Equities are equities on a piece of paper, but the reality of some equities have significantly more risk than others. And how do we add a little bit of that into the portfolio without getting too heavy in it? But yeah, diversification is a big part of it.
I saw a piece one time, or maybe a couple years ago, and I have no idea who said it, but it was like when you're betting on horse racing, right? And the only reason it stuck with me because it made sense of, instead of being able to bet on one horse, what if you could bet a little bit on every horse? And I was like, that plays right into this, because again, it's that diversification conversation of getting a little piece of the pie everywhere and adding that all together. So I think that's a great way you put it. And I just wanted to share that because I don't know where it stuck with me from, but it's just something that's in my head for a long time, and it made a lot of sense. So I figured I'd share it with those that maybe listen to this. And here's kind of that summary slide, guys. It's everything that we cover. You can always go to these, screenshot them. It's a great way to keep it in your back pocket for any tips you might want in the future. If instead of going back and rewatching this, is a great place to come to kind of get the summary. But a part of this one, risk is a part of investing. We talk about that equities and the bond side, fixed income. There's risk attached to all of it. It's a matter of how do we just manage that on each side with the weight of what we use it for. Higher potential reward means higher risk. That kind of goes hand in hand. Again, never guaranteed that just because you're more risky, you're going to have X amount more return. There is that downside risk that's attached, but over a period of time, the more risk you take, the tendency is you're going to have some more return attached to that if you're willing to stomach some of those losses that will happen on those down years. Time is your greatest ally. We harp on this time and time again. If you have the time, use it wisely, get invested. You can be a little more risky when you have that time on your side. Ride that roller coaster and use it to your advantage. We talk about goals, always balancing your risk. Know what the time horizon looks like. Maybe you only have 5 years, and now's the time to either scale back or talk to somebody and make a play on what that looks like. That's where risk comes in. We talk about, that risk versus reward conversation. That's where this comes into play of got to have goals to know what you can do. And then we just kind of hit on the diversification conversation of maybe take that horse example. Instead of betting on one horse, you can bet a little bit on each horse, just making sure that your money is spread out over more than one thing. Again, some equities have more risk involved with them. The more you can use your money in different spots, when one thing goes one way, something might go the other, and you can always kind of hedge there. So Ken, any wrap up on that for the summary? Just anything, any last final words for that?
No, I think that's a great summary. The only thing I add is everyone has a different risk profile, and it doesn't mean that every 30-year-old wants to be super aggressive, nor does it mean that every 65-year-old wants to be moderately conservative. So it's good to have open conversations with your advisor if you're working with one. A little harder to have those open conversations if you're working on your own. But do an audit of yourself and then see where you are when the markets aren't doing well. How do you feel? When the markets are doing well, how do you feel? And you'll kind of gauge your risk level.
Always that emotion attached to it, like you hit on all the time. It's just that emotion.
So we'll get to the next one. There we go. So if you have some ideas, because we've had a few people reach out, we're starting to gather some ideas for the next group of podcasts. So if you have something that we have not talked about that you're interested in, or something we've mentioned in a podcast that you'd like some more details, drop us a line. Email and text for Max and I are both in there. Drop something in the comments. We'll do our best to get to all of them as we're moving forward. But anything you have to add to help us with this, we will gladly take those suggestions.
Absolutely. Appreciate you guys tuning in.
Very good. Thanks.